Hello, welcome back. So in today's video, we'll be covering two things. We'll be covering incredibly high quality businesses as well as questions in the comment section. So let's talk about the incredibly high quality businesses first. And the first thing that we'll be covering is how to define quality. So quality is defined by the predictability of the business, basically the ability for the business to defend its market share over time. So when it comes to businesses like this, typically you want to find companies that are capital light, that can defend their market share over time, and have a secular growth trend ahead as well. So with that being said, let's talk about the first company. So the first company is in the category of your royalty businesses, and the first company is Universal Music Group. So Universal Music Group, year to date, it's up around 9%. It's currently trading at a 23 times earnings, giving you around a 2% dividend yield. So for Universal Music Group, this is their business model. Their business model is incredibly capital light. So they have the streaming portion of the business where they sign artists, they take in the artists under the umbrella, and then they collect money from the streaming services and sort of like a royalty business. And then they have other portions as well, like the physical portion where they sell the CD of their artist as well as performance rights. So majority of the business is actually under your royalty segment, basically recurring revenue that comes in from all these streaming services. And that's why the company is extremely high quality, because there is a predictable stream of income that can come in every single year. So imagine Taylor Swift's music from years ago. Universal Music Group will still be able to collect the royalty from those music a few years back. So that's why it's a high quality business. So for Universal Music Group, it's in your music streaming market. And for your music streaming market, it's projected to grow at around 15% all the way until 2030. So there's a clear secular growth trend for this company as well. And for Universal Music Group, it is actually owned by Bill Ackman as well. So Bill Ackman, he recently reduced his stake in Universal Music Group by 2.7%. He owns around 17% of his portfolio in Universal Music Group. So Universal Music Group is actually a company that is outside of the US. That's why you don't see it in the 13F. But for this company, it is one of his largest positions in his entire portfolio because it is a predictable, recurring revenue, royalty business. So if you were to look at Universal Music Group's metrics, the metrics are incredible. So ROE of 55%, ROA of 7%, ROIC of 18%, ROCE of 20%. These are incredibly healthy metrics for any business. And for Universal Music Group, these metrics are quite remarkable as well. So let's talk about the next category of stocks, and the next category of stocks will be your franchise business. So the first stock that we'll be talking about is McDonald's. McDonald's year to date is flat, currently is trading at a 25 times earnings with a dividend yield of around 2%. So for McDonald's business model, basically they operate under two businesses. They operate under their franchise businesses as well as their company-owned restaurants. So for the franchise portion of the business, that franchise portion is incredibly high margin, incredibly recurring as well, because all they do is they license out their brand to all these different franchisees, and then they collect an annual recurring revenue from all these franchise businesses, and then they act as sort of like the supply chain connecting the supplier to the franchisees as well. So for McDonald's, if you don't know, the operating margin for this business is actually comparable to a lot of your different software companies as well. So for McDonald's, the metrics are quite healthy for any food company as well. So ROC of 22%, ROIC of 15%, ROA of 13%. For food companies, it's incredibly rare for you to have companies that have ROIC of above 10%. And so for McDonald's at 15% ROIC, it's quite decent for a company in this industry. So for McDonald's, this is my valuation using the DDM model. So for McDonald's, assuming the dividend grows at around 7.5% and assuming a 10% discount rate, fair value for this stock is at around $300 a share. So McDonald's at its current price is trading at around fair value or so. And if it can fall to around $260, $250 a share, then I think it will present a good entry for this stock. So the other stock that is in the franchise portion as well is Domino's. So Domino's is one of Warren Buffett's buys, and year to date is currently up around 3%, trading at a 25 times earnings. So for Domino's, this is the revenue breakdown. So they have around 63% of their revenues coming in from supply chain. They have 32% coming in from franchise. Essentially, the entire business is just the supply chain plus franchise portion. So the supply chain business is sort of like an install base portion as well. So what they do is they collect a stream of recurring revenue from all these franchisees. They get the supplies from the supplier, and then they sell it to their franchisees, collecting a fee. So they're essentially like a distributor, and when more franchisees come in to increase the number of store counts, that will lead to even more install base for Domino's over time as well. So for Domino's, the franchise portion of the business is actually upwards of 90% of operating margin, whereas the supply chain portion is between 10 and 15%. But for a restaurant company, Domino's has incredibly high ROIC. So if you were to look at the ROIC as well, the ROIC is actually around 70%. And for any business, a 70% ROIC is incredibly high, even when this company is levered with debt. So The third category of stocks that I'll be talking about is your in-stock-based businesses. And the stock that we'll be talking about today is Pool Corp. So Pool Corp year to date is down around 13%. It's currently trading at around 26 times earnings. So for Pool Corp, they have a growing installed base. So think of it this way, when you have more pools that need servicing over time, it means that more pools needs to be serviced, which leads to more recurring revenue for Pool Corp as well. So for Pool Corp, this is their revenue mix. They have around 60% of their revenue coming from the maintenance and repair portion. That portion is almost 100% recurring. They have the other portion as well, which is under renovation and remodel. So for your pools, they need renovation and remodeling as well. Typically, your pools, they last around 10 years or so. So every 10 years, all these pools need to be renovated and remodeled as well. That makes up around 24%. It is somewhat recurring. And then the other 14% is new pool builds. So for Pool Corp, these are the growth drivers for the business according to their presentation. So with installed base growing over time, it leads to more recurring revenue. With increased affluence level as well as wealth over time, it leads to more pools being built as well. And the aging installed base also leads to more upgrades, maintenance and remodeling as well. So for Pool Corp, this is their long-term target. So Pool Corp, they aim for around 6 to 9% of net sales growth every single year. And they're aiming for an EPS growth rate of between 12 and 14% in the long term as well. And if you were to look at the stock historically, before COVID happened, it was actually growing at between 11 and 15%. So over time, if we can normalize the post-COVID boom, this is probably achievable for Pool Corp. So for Pool Corp, they're experiencing a pullback in demand. So after COVID, because of the low interest rates, as well as the stimulus checks, people went in to buy more pools. And that led to a huge increase in prices for pools, which led to more margin for Pool Corp as well, because it leads to a higher cost of your servicing and maintenance portion, which Pool Corp offers equipment for, and that led to a surge in revenue for Pool Corp. So we're seeing a normalization of this growth, and once that normalization happens, once the company can resume its revenue growth, that will be the inflection point for this business. And for Pool Corp, this is my DCF calculation. So assuming an 8% growth for the first 5 years, followed by a 6% growth for the next 5 years, this company has a fair value of around $267 a share. But if you were to increase the growth rate to around 12%, meaning to say if you think that Pool Corp can resume back to its growth rate before COVID to around 12% or so, this company is actually undervalued by around 10%. And that's why you're seeing Warren Buffett buying into it. Warren Buffett is likely buying into it because he sees a distressed business in a sector that it holds a monopoly in. And eventually, when the macro conditions become favorable for Pool Corp again, this company will likely resume back to its long-term growth rate of around 12 to 14%. So, last portion, I'll be talking about some questions in the comments. So the first one, it says, Evolution has been going up a lot. Will you be buying? So Evolution AB, what they do is they operate all the casinos online. And for Evolution, my problem with the business itself is it has a lot of its unregulated portion in Asia. So Asia actually makes up the largest portion of their growth right now. And that portion of the business is actually the highest in terms of your unregulation as well. So in UK, you're seeing regulators coming in and taking away Evolution share by imposing bans on them, because the company operates a lot of your unregulated sites there. So if all these Asian companies, they start to regulate Evolution Gaming, then that could be a headwind for the business as well. So currently now for Evolution, they're only making progress in the Philippines, but for all your other Asian companies, they're not making such progress. So for Evolution Gaming, the stock is extremely cheap. It's trading as though it is not going to grow for the next 10 years. And if you think this company can basically maintain its monopoly in this sector, then I think this company is a buy for you today. But for me, the risk for the company is quite high when it comes to your unregulated sites, and that's why I'll be avoiding this one. Next question is talking about how to analyze a company as a whole. So the comment says, I can look at the price to free cash flow, the PEG, consider the kind of company and how the ROIC is doing, look at the debt to equity, even find someone else's fancy DCF analysis. But in the end, it all feels like looking at individual pieces of a puzzle rather than looking at a puzzle as a whole. So I wanted to ask how you think about things as a whole, big picture, when analyzing a new company. What are the underlying questions you try to answer with the things you look at if you had to define the key ones? So when it comes to owning a stock, these are the few questions that you can ask yourself. Number one, is the company able to defend its market share? Number two, does the company have secular growth trends pushing ahead the company so that it can continually grow for the next few years? Number three, what are the possible risks to this company? So let me give you an example. Copart is a company that I've been reading up on. But the problem with the business itself is the AV portion of the business, and the management haven't acknowledged that yet. So if you were to look into that 10K itself, under the risk portion, they have not acknowledged the fact that the AV portion could hurt their business. So when you identify the risk, like for example Copart, the next thing that you need to do is to find a solution to the risk. So is there anything that the management is doing to acknowledge this risk? And is the management doing anything to solve this risk? Currently now, Copart is not doing anything like this, and that is why I'm still hesitant on adding into Copart, because more often than not, the risk is more important than the actual growth of the business itself. If the company can't fend away all this risk, then the growth in the future will be tempered as well. I hope you guys have found this one useful and invest safe.